IFRS 15 revenue recognition. Our issue is, do we recognize the revenue now? Do we recognize it at a later date? Or do we not recognize the revenue at all? So under IFRS 15, there's 5 criteria that needs to be met in order to recognize the revenue. First is to identify the contract. 2 is to identify the performance obligations. Third is to determine the transaction price. Fourth is to allocate the transaction price to each performance obligation. And then fifth is to recognize the revenue when each performance obligation is satisfied. So let's discuss each of these steps together. So step 1, identifying the contract. A contract exists when these 5 points are met. First is there's approval from all the parties. All parties are committed to performing the obligations. Second is each party's rights and obligations can be identified. If there's a contract, there must be some sort of exchange. Therefore, there must be some sort of right and obligation from each party. Third is payment terms can be identified. How and how much are we going to pay for the exchange? Fourth is the contract has commercial substance. So this means it has or will have impact on the cash flows. And then fifth is collectability. Can we collect the consideration we're entitled to when it is due? Indicators for this is also the customer's intention to pay and the customer's ability to pay. Moving on to step 2, identifying the performance obligations in the contract. Can we separate the performance obligations in the contract? A good or service promised to a customer is distinct if these following 2 points are met. Can the customer benefit from the good or the service on its own or with other resources that are readily available to the customer? Benefits means that the good or the service can be used, consumed, sold, or held in a way that it will generate economic benefits. On its own means, do the good or the service remain functional without the support of the other goods or services that are promised in that contract? So the second point is the promise to transfer the good or the service to the customer is separately identifiable from the other promises within that contract? So it's basically we're asking, how is it transferred? Is the good or the service transferred individually, or is the transfer a combined item or a combination of items for a single output that is specified by the customer? And could this specific good or service be purchased separately? Factors indicating, there's also factors that indicate that the good or the service are not separately identifiable. There's 3 indicators to identify that they are not separately identifiable. Are first, there's a significant service of integrating the good or the service into a combined output specified by the customer. The second is the good or the service significantly modifies or customizes the other goods and services in that contract. And then third is the good or the service significantly affects the other goods and the other services. Like it's asking, are they highly interdependent? Are they highly interrelated? The entity would not be able to fulfill the promise by transferring each of the goods and the services independently. And then We're on to step 3, determining the transaction price. For this one, we're determining the transaction price, but with considerations such as if there's a significant financing component, we have to allocate and take into consideration the effects of the time value of money. Also variable consideration. This includes like volume discounts, rebates, returns, performance bonuses, and then amounts payable to the customer, such as refunds, rebates, and also non-cash amounts. And then step 4, allocating the transaction price to each of the performance obligation. Allocating the transaction price is based on the relative standalone selling price of the performance obligation. It's the price at which an entity would sell that promised good or service separately to a customer. The best evidence for this is when a good or a service has been sold under similar circumstances to a customer on its own. So if a standalone price is not directly observable, there are 3 methods that we can use to estimate this price. So first is a method called the adjusted market assessment approach. This approach is just saying what would the market be willing to pay for these goods and services. So it's like we compare to, let's say, a competitor's price, and then we adjust it accordingly. The second method is expected cost plus a margin approach. For this one, the approach is basically we're forecasting expected cost of satisfying the performance obligation, and then we're adding an appropriate margin for that good and service. So for this one, it's expected cost plus a margin. And then the third one is a residual approach. This is like your kind of last resort. If you can't use the first 2, there are certain conditions to using this one. For the residual approach, this one is basically you're taking your total transaction price, and then you're subtracting the sum of the other known standalone selling prices that are in your contract. So your total transaction price, and then you're just subtracting the sum of the known standalone prices of the other goods and services that were promised in your contract. And then our last step is to recognize revenue when the performance obligation is satisfied. So we can recognize revenue in a single point in time, or we can recognize it over time. Revenue is recognized when we satisfy performance obligation by transferring the promised good or service to a customer. Control over an asset is the major determination of when the performance obligation is met. Control of an asset comprises of 3 things. First is the ability to direct the use of the asset. Second is obtaining substantially all remaining benefits from the asset, and then the third is preventing others from using or obtaining benefits from that asset. There's also additional indicators of when we can conclude that the customer has control of the asset, and therefore we can recognize revenue. First is the customer has accepted the asset. Second is the physical possession of the asset has transferred to the customer. Third is the customer has retained the significant risk and rewards of ownership of that asset. 4 is the customer or we have the present right to receive payment for that asset. And then 5th is the customer has the legal title for that asset. Revenue can be recognized over time if one of the following criteria are met. So there's three criteria. Okay, so the first is the customer simultaneously receives and consumes the benefit provided by the entity's performance as the entity is performing it. So the second one is the entity's performance creates or enhances an asset that the customer controls as the asset is created or enhanced. And then third, the entity's performance does not create an asset with an alternative use, and the entity has an enforceable right to receive payment for the performance completed to date.